everyone, and welcome to yet another edition of PwC Nigeria's monthly tax podcast series. In our last edition, we discussed the different executive orders issued by the President of the Federal Republic of Nigeria. Please check our page for further details, and we will be happy to respond to your comments. Today, we will be discussing 3 talking points: the deduction at source withholding tax regulations 2024, the FRS circular on the tax treatment of foreign exchange transactions, and finally, the recent 2023 Finance Acts Amendment Bill on windfall tax. My name is Mbielu. I will be your host for today, and I am joined by Kenneth Erikume, partner and lead tax reporting and strategy for PwC Nigeria. Ken is also the chief operations partner at PwC Nigeria and a veteran in tax-related matters. We are truly excited to have Ken on the show with us today. Welcome, Ken.
Thank you, Miracle. Interesting to know that I'm a veteran. I didn't know.
All right, Ken. I'm sure our listeners are keen on your thoughts and perspectives about these topics. So let's jump right in.
Sure, let's jump right in.
Starting off with the new withholding regulations issued recently by the Ministry of Finance, which has been described as a game changer for businesses in Nigeria. Can you elaborate on the challenges faced with this current regime and how these new regulations propose to address them?
Thank you very much. In the current withholding tax landscape, there are a number of issues such as when to deduct withholding tax, what type of transactions were exempt from withholding tax, sometimes excessive withholding tax rates for certain transactions, and other administrative issues. These are the concerns that the new regulations seek to address. Some of the changes in the regulations include removal of certain ambiguities. For example, in the old regulations, there was this controversy around what constitutes a sale in the ordinary course of business, and that has largely been removed in this new regulation. There was also the issue around who has the obligation to deduct withholding tax.
True.
And it then said that someone who has the obligation to deduct pay as you earn. And those things caused controversies, and those have now been clarified. Another issue is when to deduct.
Okay.
Old regulation says earlier of when payment is made or credited. And there were questions around what does credited mean.
Okay.
The tax authorities would say once you accrue in the books. Of course, taxpayers would take the view that credited means when the obligation to pay crystallizes.
Yeah.
And then you had the issue of reduced rates for most supplies in these current regulations. So the withholding tax rates for certain supplies drops. Customers are now required to issue the withholding tax certificates.
Okay.
So the previous scenario where you chase in Lagos State Internal Revenue Service or Ogun State Internal Revenue Service to get your credit notes or the FRS, now it is the customer who is paying that has the obligation to deduct the withholding tax and issue the withholding tax certificates. Customers that do not deduct withholding tax are no longer required to pay withholding tax to the tax authorities. And then there are multiple rates, including double rates where the vendor is not registered and has no tax identification number.
Okay. This seems really encouraging. I'm excited to see the outcome of this. However, there have been concerns about the implementation of these regulations, including back and forth of lack of the gazetted version. So, Ken, when do you think these regulations would be implemented?
So the current version that is out there in circulation that has the signature of the Minister of Finance stipulates 1st of July. But as you can imagine, without the official gazette from the Ministry of Justice, there is no official communication of that position to the public or to the administrator. So the Federal Inland Revenue Service, as an example for tax authorities, is unlikely to apply the gazette because they have not been officially communicated to.
Okay.
And when you look at the provisions of the current tax laws, it actually specifies that when you issue such regulations, you actually write in directly to the person who is affected or you publish it in an official gazette.
Okay.
So in the absence of direct communication to taxpayers, then it means that we all have to wait for the gazette for it to be operational. So I anticipate that the effective date will be sometime in the future when we have the official gazette already communicated to the public.
So it seems like the government is taking steps in the right direction to foster a business-friendly environment. So can you tell our businesses your recommendations on how they should respond to these new changes and still remain compliant?
So obviously there are many changes that the new regulations brings to the fore.
Okay.
While we maintain the status quo and wait for further news on the implementation of the regulations, I encourage taxpayers to think about a few things. First of all, you have to review your business processes by updating your company's accounting systems. Obviously, with the new rates, you no longer apply the old rates. And there are multiple rates in this new regulation from 0% to 2% and so on and so forth. So ensuring that your system takes into consideration the logic around those rates is very important.
Okay.
Training of staff on those new withholding tax rates and compliance requirements is also important. And we can say at this point that, PwC's Tax Academy is uniquely placed to provide that sort of capacity development. Of course, it's important to also consult tax professionals as well.
Okay.
And advisory, because while this new regulation tries to reduce ambiguities and improve efficiency, there are also some areas of controversy that it brings to the fore. For example, with the introduction or elimination of the requirement for someone who has the obligation to deduct payee as a qualifying person to deduct withholding tax. Now there's no clarity on whether non-residents are required to deduct withholding tax. So what I would like people to do is also to stay informed. Our Tax 24/7 application would give you real-time access to when the Gazette comes out as well, so that you're well equipped to implement.
Okay, thank you. Thank you so much, Ken. Moving on to the next news item. What are your quick thoughts and perspectives on the circular issued by the FRS on the tax treatment of foreign exchange differences arising from business transactions?
Again, I always like when the tax authorities come out with circulars that tells you their position on matters.
Okay.
Because that helps the tax ecosystem as well, because then taxpayers have clarity on what the FRS position is on specific matters. As you're aware, the recent shift in the naira exchange rate versus the dollar has led to significant devaluation because the central bank is trying to harmonize the rates. In the circular, the FRS reaffirmed that exchange differences are realized when the underlying transaction is received or settled, which is in line with our understanding of when these transactions become realized. The circular also attempted to distinguish between monetary and non-monetary items and clarifies that foreign currency cash balances are only realized upon conversion to another currency or when they are converted to another class of monetary or non-monetary assets or items. However, the circular does not clarify the treatment of exchange differences arising on non-monetary items. And the question is, would they be treated as capital in nature or as revenue in nature? So on that count, taxpayers would need to take position depending on how they view the matter.
Okay.
The circular also highlighted that unrealized foreign exchange gains should be included in computing minimum tax.
Sure.
However, there are questions around whether that is in line with the tax law.
Yeah.
Because the law says that the income or the economic benefits from operating activities is what will be taxed. And foreign exchange differences really do not go into the revenue line.
Yeah.
So those that position of the tax authorities would obviously be something that would be worth challenging. And companies need to reassess the historical practice of deeming prior year unrealized foreign exchange differences as automatically realized in the following year, because that would be an area of critical challenge by the tax authorities once they've come out with this circular.
Okay. Finally, Kenneth, talking about the windfall tax proposed in the Finance Bill 2024. What are your thoughts on the timing of this bill and how it affects the banking sector?
The practical administration of this amendment could pose legal and perception challenges around the principles of equity, fairness, and constitutionality. There are also implications for the banking sector. The banking sector is currently going through a recapitalization process. And the valuation of the shares of these banks would be significantly affected, and there'll be uncertainty around their public offers. Retroactive application is one of the key issues around constitutionality. And then the proposed stiff penalties and sometimes criminalizing non-compliance with the act is also an issue that would be scrutinized from a legal perspective. Another thing to be aware of is that, if the law addresses only a particular year, then there'll be questions around what portion of the profits is realized, what portion is unrealized. And then there'll be economic uncertainty as well, and further pressure on the banking sector in funding the budget. Of course, there'll be perception challenges as well. Would this be the norm for Nigeria of bringing rules that have retrospective application? So investors would also be looking at that. And we need to be able to manage that and ensure that it's communicated that this is a one-off scenario. There are questions of whether this is a windfall as well, because really it is just in dollar terms, the banks are not richer. It's just that for reporting purposes, they have to convert their financial statements or report in Naira. So there is no real windfall when you compare to the windfall tax in other jurisdictions where maybe commodity prices increases and government seeks to get additional share of those profits.
Thank you so much for your time, Ken. It's been great having this conversation with you as always. We hope our listeners will continue this conversation on their end. Do you have any final thoughts to share?
Thank you very much, Miracle. So my final thoughts on this are that we need to keep ourselves informed. We have our Tax 24/7 application, which has the free license, and we also have the paid license. But taxpayers and Nigerian citizens can get updated around tax trends and economic activities in Nigeria from that. And also, please reach out if you have any questions or require some support. We're happy to help.
And with that, we've come to the end of the conversation. Once again, I am Mbielu, and this has been the PwC Tax Recap. Take care for now.